What's up everyone, it's Caddy with MoneyVest. So in this video, I'm going to give you guys an update on my Vanguard Growth ETF experiment that we started, or I started back in September of 2021. So we embarked on this journey to basically dollar cost average every single week and really figure out, okay, does this dollar cost average strategy works even right now? And the main caveat to this was not trying to time the market and buying at the worst possible time. And that's exactly what I was able to do. I was pinpointed almost at the top September 2021. This was a couple months right before the market started selling off, before the bear market kicked off in 2022. And the idea was to, once again, dollar cost average and see where we end up, see where I end up in this experiment over the long term. So 5 years, 10 years, 15, 20 years down the road. And since then, I've given you guys a couple updates already. I'm going to break all that down. And I got to really admit here that I haven't been consistent with my dollar cost averaging, more specifically in October and November of last year when I should have been a little bit more aggressive. But that's because I was dollar cost averaging in other stocks and other companies that were actually far more appealing from a risk reward standpoint. So I have to admit I haven't been as consistent, but I promise moving forward, I'm going to dedicate a specific dollar amount into this strategy and dollar cost average more consistently every single week. So I'll give you guys an update on where that position stands right now, whether I'm up or down, or what's the current P&L looks like for that potential experiment here. And of course, moving forward, I promise I'm going to be a lot more consistent with dollar cost averaging with a specific dollar amount dedicated each week. So this right here is the video I posted 1 year ago, buying this ETF on Monday, new investing experiment, buying at all-time highs. And again, that was the idea, is that even if you buy at the worst possible time. This was literally the time when the Federal Reserve was starting with rate hikes. They were taking liquidity out of the system. They were pretty much starting quantitative tightening. Inflation was running a little too high. So there could not have been a worse time to start this experiment. This again came out on September 12th, 2021. And this was where my first entry was, right? So this is from that video where I basically go over my first entry. Of course, the markets did drop about 5 to 6% from those levels. Dollar cost averaged here. Then, of course, they rallied 15%. Dollar cost averaged here. And in this update, I basically mentioned that I was break even. I was very break even. This was my first update after the experiment started, where I was pretty much break even because my actual cost basis was very similar to where the price at the time was trading at close to $308 per share, because I dollar cost averaged down here, I dollar cost averaged up here, and all in all, I pretty much ended up at the same price where the VUG stock was trading at, which is the Vanguard Growth ETF. Now, the main reason as to why I wanted to, and this right here was July of last year. So September 2021 is when I started. I gave you guys an update a couple months later because markets obviously were selling off and then they rallied back higher. So I was break even. But this right here was about 1 year ago, July 2022, when it was down a little bit over 20%. Of course, it makes a lot of sense because, well, markets were selling off. We were in a bear market. I was down almost $8,000, and the value was just under $30,000. I had about 125 shares. Now, this was also the time where I did dollar cost average, but again, not as aggressively, not as much as I personally should have. And that was kind of because of the less buying power, cash exposures getting drained out because I was buying other stocks and, selling cash secured puts, taking advantage of market sell off here in October, November, September, like around that time in 2022, when we were like literally at the bottom of that bear market. So that's on me because, again, this was the experiment. The whole idea was to dollar cost average a little bit more consistently and to see where the results are going to be, 3 years, 5 years, or 7 years down the road. So I'm gonna definitely try my best, and I promise I'm gonna be a lot more consistent now with respect to dollar terms dedicated each week. But of course, with the bear market, I was down a little bit over 21%, almost $8,000 in July of last year. And the main idea behind this entire sort of strategy, and this is actually a video from July 10, the portfolio that I just showed you guys. I'm going to play this clip just so we can kind of understand what the philosophy was. And, we're going to go back and listen to the young caddy here with no beard and listen to what this video has to say from July 10th, 2022. So I'm going to pause my microphone. Let's do this now. give you guys the next update once we cross the full year, and then I'll give you guys update periodically every quarter, and then kind of go from there. So this is going to be a good thing for people who are always asking that, if I were to buy, let's say the S&P 500 or any index fund or anything, is this the time to buy, right? When you ask that question, is this a time to buy? Once I show you this experiment, and my expectations are that eventually this position will turn green, right? So we will be able to turn a profit for this. The answer to that question will always be yes. It'll always be yes, because if I can buy this at the worst time possible, if I can buy this at the top, at the peak, when the markets were, somewhat overvalued, there was potentially fears of a bubble, and of course the Fed was starting to take liquidity out. This was literally the worst time to pick up VUG, and I had to, because this was the whole point of that experiment. Even then, when you can turn a profit, at least that's what my expectation is, that this will eventually turn into a profit, then you asking that question, should I be buying the S&P 500 index fund? The answer is always going to be yes. Why? Because nobody can time the market. And all we can do is dollar cost average. And dollar cost average over time, my expectation is it will win, right? It will do much better. So this position will eventually turn green if I'm able to consistently dollar cost average, bring down my cost basis, and it's already showing it, right? So I'm only down 21% versus VUG, which is down over 28% from all-time highs. So once it starts to recover, the position will also flourish, in my view. So that's something that I wanted to go over. So that's something that I wanted to go over specifically, because if you kind of listen to what I said last year, and the question that most people ask is this the time to dollar cost average? Is this the time to basically be buying, right? Buying stocks? And the answer to that question will almost always be yes. And the reason is, if you are dollar cost averaging in a broad-based, diversified ETF or an index fund, the dollar cost averaging question will almost always be yes, in my opinion, because if I can buy at the worst possible time and be down 21, 22, 23%, almost $8,000, and continue to do that and follow that process, well, guess what? Markets did recover. Markets did push higher, right? Markets did start to push higher. As I mentioned 1 year ago, that my expectation was the markets will recover and this position will eventually turn profitable. Well, we're not there yet. This is my existing position now. This is my most recent position, but we're break even. But I'm break even now, only down about 1.65%, down about $1,200 now. And it's only a matter of time, in my opinion, if I continue to dollar cost average, if I continue with this experiment, the chances, the probability of this turning green is significantly higher, right? I mean, markets are already back up to almost all-time highs. And like I said, this would have turned out a little bit better had I allocated more funds towards VUG and had been a little bit more consistent with that experiment, as opposed to buying Tesla or Meta or any of the other companies during that October, November lows. I mean, they did really well, right? I mean, they went up 100, 200, 300%. I can't complain there. But with respect to this experiment, yes, I did sort of fall back on my dollar cost averaging consistency, right? I was not able to DCA as much as I wanted to. But bottom line is, bought at the worst time, bought at literally the market peak of September 21. Federal Reserve was raising interest rates. Federal Reserve was, taking liquidity out. They were doing a lot of quantitative tightening. Inflation was too high. Dollar cost averaged, of course, not in a very consistent way, but did in a way that made sense to me. Down 21% from peak to low, and then recovered all the way back up. And now the expectation would be for this to turn green fairly soon in the future. And this right here is another chart that I wanted to go over, which I have talked about in one of my previous videos, where it basically goes over what percentage of times the markets are down over 20% from their all-time highs. And that is a really, really, really low number, right? So if you take a look at these right here, the red marks, right, for this chart, this is the S&P 500. And you'll notice that in the last, I would say this data goes back to 69 years, so 1950s, the markets are down over 20%, only 17% of the time. So 83% of the times you have the S&P that's within 20% from its all-time highs. And this was what I wanted to test. This is exactly what I wanted to experiment and better understand, that if I consistently DCA in a broad-based ETF, what are the results going to look like years from now, and can the markets actually continue to push higher and achieve profitability using that experiment. So that's where we are. And again, I'm going to be buying more and more and dollar cost averaging more into this broad-based ETF. And the one thing that I want to make sure that everyone understands is that this is simply a broad-based ETF experiment only. It doesn't work with individual stocks. And the reason for that is because stocks are changing. Companies are changing every single day, every single month, every single year. A hotshot company that's doing really well today may not be the best performer 5 years from now, but ETFs and broad-based indexes includes everything, right? So as long as the economies, global economies in the world are growing, as long as productivity is growing, as long as money supply is increasing, there is going to consistently be companies that are doing well that are going to be included in those ETFs, and those ETFs and indexes are going to do well. So hope you guys enjoyed this video. Let me know your thoughts in the comment section down below. And again, I plan to restart. I've been buying more VUG recently as well, and I plan to once again consistently restart that dollar cost averaging experiment with this ETF. I will be starting a brand new ETF, another one with a new experiment, and I will be going over that in another video. But hope you guys enjoyed this one, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. As always, happy investing. I'll see you all in the next video.